tonight, we're gonna first thing to do is finish the chapter 13 handout bonds payable. And then we're gonna do the multiple choice review for chapter 13 and practice exam for 13. And I'll email the exam after class. It'll be due, everything will be due on the 24th. Okay. So I think, I think we stopped off on 14. Excuse me. And so sometimes the bonds, let me see if I did this right on this. Okay, so sometimes they're shown as a percentage. Sometimes they'll just tell you what the proceeds were. You know, so in this case, that they'll show you that these bonds had a face value of 150,000, and they had but they were issued for 89,783. Okay, so let's go ahead and do the journal entries. And again, this is it seems like a long time ago, but this is from last time. Kind of the stuff we're going to do. So the first thing you do is you put the CAC on the books. Zoom in a little bit. Okay. So cash, it's an asset going up. And 89. Nope. Try that again. 89,783. 89,783. Okay. And our bonds payable. The liability. It's going up. Okay, now we got less than the face amount. So is this going to be a premium or a discount? Oh, come on, you guys know this. What's it going to be, premium or discount? Yep, thank you. Discount. Yeah, it's going to be a discount. We got less than we have on the face. Now, this discount is actually a liability going down. Hold on a second. Let me get rid of all this. Okay. This will actually reduce our liability by the difference between those two, which is, oh, darn it. I'll use my old lousy calculator. Okay, 150,000. Actually, my old lousy calculator works pretty well. 60,217. And again, I think I talked to you about this last time. Let's see if I did. Yeah. So the cash is going to be the asset. And if your balance sheet is going to balance, your liabilities have to balance too. And so this is what really happened is that you have cash on one side. So here's your asset. And on the other side, you're going to have your liabilities. Now notice that if we just put this $150,000 on, our balance sheet isn't going to balance, for one thing. Oops. So we're going to subtract out the discount. And so our net bonds payable will be the 89,780. Okay. So the asset we picked up was this. This is the liability. Again, they have to equal. So balance sheet's not going to equal. So this is they're going to be the same. And if you think about it, I mean, it is that these things did happen here. It's not saying that they did, but if you look at the reality of it, what did we do? We borrowed 89,783. That's how much we borrowed. You know, that's much cash they gave us. That's what we borrowed, and we borrowed it at 12%. Okay, so let's go on to the first interest payment. Now, the bonds, the cash payouts. Let me talk about this a little more. I don't think I talked about this like I should have last time. Okay, this first one here has a face value, stated interest rate of 5%. 10-year bonds are issued semi-annually. Okay, this is what they call the indenture agreement. This is the contract between the buyer of the bonds and the seller. Those people that are lending us money and us. This is the agreement. We're telling them, look, we're going to pay interest on 150,000. We're going to pay it at 5%, and we're going to pay it semi-annually. So this is the indenture agreement. This is the contract. That we are, that's on those bonds. Okay, so our cash payout by this agreement is going to be 150,000 5%. Paid semi-annually. So that is what's written on these bonds, and that's what we're gonna pay. So I'm gonna put in one more line here. I goofed everything up. Okay, so our cash payment by this indenture agreement equals 150,000 times 5% times 6/12. You could also just divide it by 2. Same thing. Equal some number. $37.50. So by contract, we must pay $37.50. So coming down here, I'm going to copy this whole thing. Come down here to the second one here. So cash is an asset going down. We got to pay this interest payment of $37.50. And again, this comes off the indenture agreement. There's regardless of what we sell it for, this is what we have to pay because that is what's on the contract. Okay. Interest expense. And interest expense is really, what did we actually, at least for this first year here, what did we actually borrow? We actually borrowed $89,783. That's the carry value of it. You see that here too. Same thing. And we really borrowed it at the market rate of make it yellow, I guess. 12%. Times 6 divided by 12, or it'd be divided by 2 is another way to do it. Same thing. Okay, time for Mr. Calculator. I'm gonna round this off to the nearest dollar, and feel free to do that on the test. Let me put that in here. Uh, 53.87. I should probably put that down here. Okay, so these two sides don't equal. What do we need to make them equal? what do we need to make our debits equal our credits?
The difference in the discount amount.
Yep. And I think it comes out to, you may check me on this, 1637. Yeah, he is right. Okay, and yes, this will be out of the discount. So this discount, this liability is now going up. We're adding more of this liability onto the books. A better uh, let's make it that. So this discount, you know, it's we're reducing this discount here. So this is adding to the liabilities, you know, it's less of a discount, but the way it works out is you just take the the carry amount of the bonds was at least initially 87, I say 89, 783. And the discount is going to add to that. 16. Whatever that is. So our liability is going up. $91,420. Yeah, that's it. So you can see our liability now has gone up from 89 up to 91. And what's going to keep happening is this discount here is going to keep going down and down and down for the next 10 years. It's going to go down and down and down until this discount completely disappears. And all we're left with is this liability. And two, if you look at this, our interest expense, what we kind of owe these people was $5,837. How much we pay? We paid $3,750. We didn't pay the full interest expense. They're not just going to forget about the $1,637. They're going to add it on to what we owe them. That's kind of what's going on down here. This is getting added on to it. You know, we owe them $89,783, plus we didn't pay the full amount that they were looking for. They were looking for $5,387, so they're not going to forget about that. They're going to add that onto what we owe them. It's kind of jumbled a little bit because it goes through different accounts, but that's basically what's happening here. Okay, cash. The cash account does not change. That's a contract. So coming down here, that's going to be exactly the same. This comes off the indenture agreement. Indenture agreement says we're going to pay $3,750. We're going to pay $3,750. Okay, interest expense. Now we owe them more money. We owe them 91,420, so that's what we're going to. %12% is the market rate. That the 12% will stay the same. The amount we owe them is going to change. We owe them more money now, but they're still going to charge us 12%. Times 6/12, or just divide it by 2. And I'm going to round it off the nearest dollar again. By the way, if you don't want to round it, you can keep those, and there's nothing wrong with doing it that way. I'm just doing it for speed it up. So 54.85, it looks like, rounded. And the difference between those two, $17.35. And again, it's increasing those liabilities now. We paid them $37.50. They wanted $54.85. They're not going to forget about it. They're going to tack that on, and so starting over in going from January to June 30th in 2024, you're going to tack this on to it, onto the 91,420. And it'll just keep going up and up and up, the carry amount of the bonds until it hits 150. What's on that? All right. Whoa, weird little spacing here. And by the way, this kind of shows you why these were sold at a discount. The contract, the indenture agreement, had that we were paying 5%. The market said, okay, your company and in your financial situation, you should be paying 12. So the market rate, if it's higher than the indenture agreement or higher than the contract rate, these are sold at a discount. The market wants more. That is actually printed on those bonds. Okay, 15. And by the way, you can see on this one too, these are sold at a premium, right? They're sold at more money than the face value. They're paying 10%. And the market wants 8. So because the market only wants 8, we're paying 10, they're going to bid up the price of those. And again, this whole thing up here This is the indenture agreement. Probably makes it look worse. Oh, I know what I can do. I can make it wacky. Ah, see? Boy, is that ugly. All right. See, I give you guys ugly presentations so that you remember them. I'm gonna laugh at these instructors that have good looking presentations. Okay, so this is the so this is the agreement. It's 360,000. The stated rate is 10%. And they're gonna pay interest semi-annually. And again, that's stated on the bond, so that's what we have to pay. So coming down, oh wait, I didn't do the first entry. Oopsie daisy. So our cash. Asset going up. We sold these bonds, we actually borrowed money. 401. And we're gonna have a premium here. So for more than the face mount. And that's a liability going up, and that'll be for 41,948. I think that's what 41. Yeah. Oh, I know. Here, I'll show you what this looks like. Right after we make this sale, it'll look like this. Copy this down just to save time. So this would be our asset and our liability. And again, they have to equal. Else our balance sheet won't balance. So right after we make, this would be on January 1st. I should put that on the other one. Our bonds payable will be 360. The premium on it will be 41. We'll actually owe 401,984. Right, we do it. And that, if you think about it, that makes sense. How much do we borrow? Well, what did they write the check for? How much cash do we get? That's what we borrow. 401,948. you know, this other stuff is kind of making it, you know, come out right, but, yeah, this is what we really borrowed. Now, eventually, this premium is gonna go down to 0, and we'll just pay off the 360. All right, so let's see what we're gonna do, how we're gonna do that. All right, the indenture agreement. 360, 10%. Paid semi-annual. I'm gonna do it up here just to keep it all in one. So I don't goof up, basically. So 360. Times 10% times 6/12, or just divide by 2. And that is. Should be able to do that one in my head. Yep, I should have been able to do that in my head. 18,000. Okay, so this is gonna be our cash payment. And again, this comes out of the indenture agreement. You know, they're gonna be expecting this money, because that's what we told them we're gonna pay, is we right in the contract, basically. So we're gonna make this payment to them, 18,000. We're going to have our interest expense. Is 401. What we borrowed. 401,948. And at what rate did we actually borrow it at? We actually borrowed it at. See if I can get these a little closer. We actually borrowed it at 8%. Let's make that color. Oh, no, don't do that. Hold on. It'll be right here. And again, I'm gonna round it off. I'll put it up here. All right, rounded 16,778. And so we need a wait a minute. No, we don't need a credit, we need debit for our premium. And this is going to be a liability going down. $1,922. And in this case, we don't have a discount. But we do have a premium, so we have minus 1922. You may want to check, make sure that 1922 is right. I think it is. 17, yeah, okay. I better check that. Yep, that's it. Okay. So we just start the whole thing all over again. New number though, 401. No, 400. Oh, 26. It's still 18,000. This is gonna be 18,000 every single year. It's not gonna change. It's in the agreement. $16,001. So that is and this premium is gonna keep going down and down and down until it goes to zero. And then at the end, we'll have this 8 years. 8 years. At the end of 8 years, we're just gonna have the 360 left. The premium will have disappeared completely. We'll just have the 360 left, and that's what will pay off. Okay, one more. We'll take a break, and I gotta find out the multiple choice question. Okay. Well, let's take a look at this. I'll do the same way I did before. So this is the indenture agreement. And this is sort of like the contract. Oops, with bondholders. Bondholders is one word or two. Anyway. So this is the contract. And it spells out everything that's going to go on with this, these bond issues. And it says we have a face value of 240,000. The interest rate on the bonds is the stated rate, contract rate, indenture rate, a few different ways they can say it. 9%, and they pay interest semi-annually. Okay. No, wait a minute. I was gonna make this all goofy looking like I did last time. Hey. There we go. I'm gonna take off massive amounts of points if you guys don't do that. I'm kidding. All right. So the indenture agreement. Is that okay? So coming down here. Is this gonna be a premium or a discount, by the way? Anyone?
Discount.
Yep, very good. We're getting 224. We owe. Yeah. $40 for the face value. But we have a discount. In the book, they show it as unamortized discount on the bonds payable. They're going down, the difference between these two. $15,203. Okay, so from here we'll have the cash interest payout. So by contract, we're gonna pay interest of 240,000. We're gonna pay 9%. And again, this is right in the contract. We have to do it. Oh, no, wait. One more. These are semi-annual, so you just divide by 2 if you want. Fine. $10,080. This guy's at 10,800. Okay, so this is our cash we're gonna pay out, and again. We said we're gonna pay that, we have to pay that, it's on the agreement, in the indenture agreement. We're gonna pay out. Interest expense is going to be the 224. Nope, don't do that. Times. The market rate for these was 11%. Make it green. How about? Times 6/12, or simply divide by 2. Either one is perfectly acceptable. And round it to the nearest dollar. Oh, hold on, this is oopsie daisy. Wait, don't do what I just did. That was the evil mark showing you the wrong way to do it. Okay, let's try this again. So 12,364. And again, if you want to keep the pennies, you can. There's nothing wrong with it. And you'll see here, you can kind of take a look and notice that here's what the market wants. They want 12,364. We're only paying 10,800. So this will be the discount that we're reducing it, and so this will be liability going up. They're not going to just forget about the shortage there. $15.64. Okay, so this is what we really borrowed. And this is what they wanted. We shorted them $1,564. So they're gonna add that on to this 224,797. Copy this thing down. Okay, so and we don't have a premium here, we have a discount that we're going to add on to this for 15. And that'll give us whatever this is. Oops. Two 360. Okay, I think that's what it is. You want to check that number? Okay, and again, everything comes down here. This is still gonna be 10,800. That is in the contract. We have to pay that no matter what. This went up to 226, 361. Let's see what that looks like. $12,450. Rounding it off to the nearest dollar. And again, if you keep there's nothing wrong with keeping the cents. If you want to keep the cents, that's fine. And so this, we're gonna have a discount is it's gonna be reduced, so your liabilities are gonna go up by the difference between those two. $1,650. Okay, on the test, you're gonna get a discount and a premium bond. You know, to do the problems. Okay, I tell you what, let's take a break, and while we're on break, I'll send out the multiple choice questions. So let's say what time is it? Let's say, I'm gonna say 7:10. I don't know. Okay, next I'm gonna do a multiple choice review, and this way you get the extra credit points. There's only 5 of them, so if you get 2 correct. Hey, oops, no. 2 will be plus 2, 3 will be plus 3, 4 will be plus 4, and 5 will be plus 5. This is a class. You know, there's only 5 of them. I'll give you extra credit for plus 1 for each correct. Make it nice and simple. Okay, so I'm gonna start the poll. And so put your answers in, and again, don't worry about if it's, you know, when I give the results out, it doesn't say who did what. So don't worry if it, don't worry about your answer being seen by other people. You put your best your best guess in there, and yeah. But best guess if you don't know. And questions 6 through 10 on the polls. Can be anything. You don't have to. The polls have to be made out ahead of time. And so I was making for 10, and but we're only going to grade 1 through 5. So 1 through 5, you'll have something A, B, C, or D, and then 6 through 10, you could have whatever you want. But they make you put in all 10 of them, I believe. Is there anyone that did not get the multiple choice? I sent them out in the email. Okay, looks like I've already answered. Let's share the results. One, yep, indenture agreement. Or bond indenture, I can say. Okay. Bond selling price indicate they were paying higher than the market rate. That is right. Good. 2 for 2. The selling price of the bond is present value of the bond or the par value plus present value of the interest payments. Yes, the 3 of them. 4. 4 and 3 and 4 kind of nearly the same. Put it in different words, but yeah. Present value of the present value discount on market. Yeah. Good. Ah. 5. C. It's the effective rate when they were sold. If you remember when we did the valuation of the bonds, it was like what the market rate was when we sold them. So it's when they're sold. Now, if it changed from year to year, and the kind of odd thing is, you guys got 5 out of 5. So, the kind of odd thing is that you hope the interest rate goes up because then your liability goes down. So the changing of as you go through and make the payments, you use the original current rate, original market rate. But as time goes on, that could change. You still make the same payments based on the original sale. However, if it does change, the current rate does change. You hope that it goes up, because if it goes up, your liability goes down. And so it's possible you could say, instead of having 400,000 of a liability, maybe you have 320,000. But you could pay off your $400,000 liability with 320,000, whatever it is. And you actually have a gain on getting rid of your debt. Okay, so let me the poll here says stop sharing, and like that. Yeah, don't share anymore. We download the results. Okay, I sent out the practice test. These are the problems in the practice test. It's a little bit redundant, but we'll go through those. Wait a minute, let me do something here. Just to make sure. And by the way, if you're wondering why, I'm kind of doing all this, it's because a couple of reasons. Give me 1 second here. Get back to my screen. Okay, no, if you're wondering why, it's because when I would give exams in the past, I would just give here's the problems and I give the exams and then people get, well, especially on multiple choice questions, a lot of times people get them wrong. And then we go and discuss them in class afterwards and then people go, oh, okay, that makes sense. And I thought, this is kind of backwards. I should be doing the multiple choice questions up front, and then we talk about them, go, oh, okay, yeah, that makes sense. Do that ahead of time and then take the test. And then also these tests are short, so which is good. And well, the good thing is you remember more of it, and you do better on it. But also that the drawback is if you, because each problem is worth more points. If you do get one wrong, you lose more sometimes. Okay. Let's just go ahead and plug these in. We've done these enough that we can probably just go through them without explanation. Unless you want me to. And by the way, you do not have to put in these, asset going up thing or anything like that. You can, nothing wrong with putting it in, but it's not necessary. What is this? Premium? Oh, wrong line. Sorry. Ah. Okay. So we're promised to pay $50,000, 12%, and semi-annual. That's all we need, right? So that's the indenture agreement. Okay, interest expense. Interest expense is what we really borrowed. We really borrowed 65,247. And we borrowed it at 8%. Yeah, I'm gonna round it to the nearest dollar, 26.10. You don't have to round it to the nearest dollar. You can keep the. You can keep the pennies if you want. Nothing wrong with it at all. Okay, so let's see. So our premium will go down, which will cause, oh, this is liability going on. Sorry, this will be liability going down. By the difference there, 390. And eventually that premium will go down to 0. Okay. Bond carry amount. 65,247. Oops. And we're going to minus any premium payments in the interest. And plus any discount payments. Now, we're not going to have both of those. It'll be one or the other. In this case, we have premium. We're going to subtract out 390. $594. Uh, 406. You want to check that? And again, it's either going to be a premium or a discount. You're not going to have both of these. It's going to be one or the other. Question on that? All right. Let's jump to the next one. One's going to be a discount. Discount or unamortized discount on bonds payable or whatever. Discount, just saying discount's fine. Reducing our liability by some. All right, so that's our liability. That's the discount, and that's going to go to zero eventually. Okay, so here's our indenture agreement. $60,000. We're paying 7%, which is why these are at a discount. The market wants 10. So, and these pay interest semi-annually, which they've all been pretty much. All right, so we go. Okay. So our cash, we're paying out cash of 60,000 times 7% divided by 2. Six over 12. Same thing. 21,000. We off 2,100. Okay, so our cash payout is 2,100. Our interest expense is really, how much did we really borrow? We really borrowed 52.23. What rate did we really borrow it at? We really borrowed it at 10%. Times 6 divided by 12, or again, just divide by 2. Same thing. $601. Have we had it before? So the difference between these two is. I believe going up is what, 501? Seems high. Oh, these are short life. Okay. All right. So this discount is just gonna keep going down until it's 0, and what'll be left is a balance payable at 60,000. So we owe 501 more now. Yeah. Okay, now, how much we owe? It's gonna go up by 501. Up there. So this will be 52. 524. I think. Yeah. Okay. I'm gonna copy this mess down. That'll be the same. This one will not. This one will not. This will be. That. Okay. $626. That's it. Question anywhere? All right, well, that's probably enough fun for tonight. So what I'm gonna do is I'm gonna send out the exam. They are due on the 24th. So a week from Friday. And you should be getting those. Probably like within 10-15 minutes or so. Any questions? Okay. Well, I will see you guys next week, and I will be sending out those exams. Be looking for them by probably like next 5-10 minutes or whatever. But you have 10 days to do it. So a week from Friday. Questions?
No questions. Okay. Thank you.
Have a good evening.
Thank you.
Bye, guys.